Hello, everyone. Greetings from the channel, Autodidact. We are back with another discipline, stock market investment, a complete course to make from a naive to an expert. Dear future investor, one bitter reality is that for newbies to stock investing, the stock market hasn't been offering the warmest welcome in recent years, but, believe me, it can be rewarding. Your own channel Autodidact is starting a course in the share market for beginners. I can only promise you that if you complete this course seriously, you'll do much better than the average investor. Just keep in mind that patience and discipline count now more than ever. The purpose of this course is not only to tell you about the basics of stock investing, but also to let you in on solid strategies that can help you profit from the stock market. Before you invest, you need to understand the fundamentals of stock investing. Then I give you an overview of how to put your money where it will count the most. For easy understanding, the information has been put in a straightforward format. The parts progress in a logical approach that any investor interested in stocks can follow very easily. Hence, we have 4 modules in total. The very first module includes Essentials of Stock Investing, where we will be learning the basic terms and concepts that are commonly used in the stock market. When you're ready to embark on your career as a stock investor, you need to use some resources to gather information about the stocks you're interested in. In the second module, you can learn where to find information and how to use it to be a more knowledgeable investor. The knowledge will be able to steer you toward those segments of the stock market that will reap you profits invariably, and it will make your stock portfolio thrive. So, in Module 3, we will be making strategies before buying a stock, based on the information we have gathered. Module 4 will enable you to make the investment strategies and devise them in the real market. So, let us begin our learning tour with Module 1. It will brief you about basic terms. It will tell you about stock market and its working. Furthermore, the equities and commodities, and lastly the market index. Alright then, firstly the types of companies. There are 2 types of companies: a public company and a private company. A public company has issued its shares to the general public on the stock exchange. We can say whose shares are available in the share market for trading. For example, Reliance, State Bank of India, Yes Bank, Infosys, and so on. Whereas a private company is one which holds its shares to a few big money investors only. The common public do not have any part of ownership in them, like Paytm, Dell, etc. Next term is shares. So as the name suggests, a share is a part of a company which you can buy or sell. If the company is publicly listed, that is on a stock exchange, means if you are buying a share of the company, you have become the owner in that company, at least that value. For example, let's say a company Autodidact has a worth of ₹1,000 right now, and it has 100 shares in total. In this case, the price of one share will be ₹10 per share. Also, one share would be 1% of the total company. Similarly, if the company had 200 shares, then one share would be 0.5% of the total company, and so on. Conversely, the total number of shares of a company multiplied by the price of a share at a given time is the market capitalization or market cap of the company at a given time. We can take an incidence for reference. The company Autodidact, which has 100 shares in market. If the share price is ₹23 presently, the market capitalization of this company is ₹2,300 only. We got this is 100 shares multiplied by ₹23. Alright, next term is stocks and shares. The 2 words are used interchangeably, though there is a slight difference between the 2. A stock can refer to any arbitrary company, but the word share is used when we are referring to a specific company. For example, you can buy stocks of 20 different companies, but you can buy the shares of Reliance, which is a specific company. Moreover, share market and the stock market are one and the same thing. Moving ahead, when we invest in market, we have 2 options: 1. We can buy shares of single company with all of his money. Secondly, he can spread his money for buying several stocks of different companies. So, if you have invested in more stocks than one, let's say 10 different stocks, then this collection of investment is known as a portfolio. We can understand this with an example. Let's say Tony Starks has invested rupees 1 lakh in the stock market. He bought several stocks of the companies including Reliance, TCS, Kotak Mahindra Bank, and Baxi and Colgate in different proportions. Then, his portfolio can be visualized like this chart. These all shares are bought and sold on a stock exchange. Every country has these stock exchanges. In India also, initially, we had 120 stock exchanges. They all were merged into 2 stock exchanges. One of them is the older Bombay Stock Exchange, often called BSE, and the other is National Stock Exchange. NSE. Unlike the conventional markets, all transactions nowadays take place electronically, as these markets are electronic rather physical. There are thousands of companies registered at stock exchanges. It is very difficult to monitor the performance of these stocks at one point of time. So, a representative number is calculated that shows the overall performance of all the stocks. So we can define it as an index that measures a stock market, or a subset of the stock market, that helps investors compare current price levels with past prices to calculate market performance. It is computed from the prices of selected stocks. Typically, a weighted arithmetic mean is calculated to calculate the market index. We will later on learn the method of calculating market index. As we have 2 stock exchanges, so we need 2 market indexes to showcase the performance of all the companies registered with them. The index calculated for NSE is Nifty, and the index calculated for BSE is Sensex. The Nifty includes 50 shares, while the Sensex takes 30 stocks to calculate the index. It is usually taken care of that share from every industry is included so as to calculate the index number. These companies are revised every quarter after a committee recommendations including finance minister, stock exchange chief and corporates. A term trend usually refers to the general market direction and its associated strength. It happens every day, minute and second that the stock price fluctuates. There are both ups and the downs. And we cannot take any decision looking at these ups and downs, so an overall direction of overall movement is drawn to identify the trend. For example, if the market is declining fast, the trend is said to be bearish. If the market is trading flat with no movement, then the trend is said to be sideways. You can observe in the share price chart, there are hundreds of upward and downward movements. But the blue line is displaying the trend, which is upwards, means bullish is the market. Next is bull market, often called the bullish. This is the anticipation. If you believe that the stock prices are likely to go up, then you are said to be bullish on the stock price. From a broader perspective, if the stock market index is going up during a particular time period, then it is referred to as the bull market. You can see this with opening price and closing price. If opening price of share is lower than the closing price, then it is bullish. For example, if Tech Mahindra opened at rupees 565 and closed at rupees 605, then it is bullish. Similarly, bear market, often called the bearish. If you believe that the stock prices are likely to go down, then you are said to be bearish on the stock price. From a broader perspective, if the stock market index is going down during a particular time period, then it is referred to as the bear market. For example, if opening price of a share is higher than the closing price, then it is bearish. For example, if HDFC Bank opened at rupees 1200 and closed at rupees 1140, then it is bearish. 52-week high is the highest point at which a stock has traded during the last 52 weeks, which also marks a year. And likewise, 52-week low marks the lowest point at which the stock has traded during the last 52 weeks. The 52-week high and low gives a sense of the range within which the stock has traded during the year. Many people believe that if a stock reaches 52-week high, then it indicates a bullish trend for the foreseeable future. Similarly, if a stock hits 52-week low, some traders believe that it indicates a bearish trend for the foreseeable future. All-time high-low is similar to the 52-week high and low, with the only difference being the all-time high price is the highest price the stock has ever traded from the time it has been listed. Similarly, the all-time low price is the lowest price at which the stock has ever traded from the time it has been listed. OLC stands for open, high, low and close. We will understand more about this in the technical analysis module. For now, open is the price at which the stock opens for the day, high is the highest price at which the stock trades during the day, low is the lowest price at which the stock trades during the day, and the close is the closing price of the stock. For example, the OLC of ACC on the 17th of June 2019 was 1486, 1511, 1467 and 1499. Turnover for a trader, so the total money he transacted for buying and selling of stocks. It can be calculated as a product of total volume traded to the average price of a stock for the day. We'll understand this with an example in a few moments. Deliverable quantity is the number of shares which were not squared off on an intraday basis. Means we bought them and didn't sell them on the same day. These shares will now be delivered to our account. Volume of total traded quantity and its impact on the stock prices is an important concept. Volumes represent the total transactions both buy and sell put together for a particular stock on a particular day. For example, on the 17th of June 2019, the volume on L&T was 533,819 shares. Okay, let us calculate these things. Firstly, we'll calculate volume and deliverable quantity for a trader. Then we will calculate turnover of the same trader. Let us begin with calculating volume and deliverable quantity. Let's say on the 4th of January 2020, Mr. Starks did the following transactions. At 10 a.m., he bought 300 SB shares at Rs 312. At 11:30 a.m., he bought 200 SB shares at Rs 304. At 12:30 p.m., he sold 250 SB shares at Rs 311. At 2:45 p.m., he bought 100 TCS shares at Rs 1800. At 3:15 p.m., he sold 50 TCS shares at Rs 1835 and bought 50 SB shares at Rs 307. Then his traded volume for SB is 800 shares as he bought 250 shares and he sold 250 shares. So, 300 plus 200 plus 250 plus 50 makes it to 800. Similarly, for TCS, the traded volume is 150 shares. To calculate deliverable quantity, we must look at the number of shares purchased against the number of shares sold. Like for SB, we bought 300 then 200 then 50. Means we purchased 550 shares. But, sold 250 shares. After the closing will be given 300 shares, which is the balance of the trade. Likely, you can calculate for TCS, the deliverable quantity will be 50 shares. To calculate turnover, the simplest way is, multiply the prices with quantity and calculate sum total. Another shortcut is by calculating the product of total volume traded to the average price. Like, the total number of shares traded was 550 for SB. We bought 55% of shares at the rate of Rs 312, 36% at the rate of Rs 304 and 9% at the rate of Rs 307. So, the average price would be Rs 308.64. After multiplying this with the total 550, our turnover becomes Rs 169,750. Long position or going long is simply a reference to the direction of your trade. For example, if you have bought or intend to buy Beacon shares, then you are said to be long on Beacon or planning to go long on Beacon respectively. If you have bought the Nifty index with an expectation that the index will trade higher, then essentially you have a long position on Nifty. If you are long on a stock or an index, you are said to be bullish. Going short or simply shorting is a term used to describe a transaction carried out in a particular order. This is a slightly tricky concept. If you have sold the Nifty index with an expectation that the index will trade lower, then essentially you have a short position on Nifty. If you are short on a stock or an index, you are said to be bearish. To summarize long and short positions. In long position, firstly we buy at low price and sell at high price when the share price goes up. In this case, you will make money when the market is bullish. In case the market moves down, you incur a loss. But in short position, firstly we sell at low price and then buy at high price when the share price has moved down. In this case, you will make money when the market is bearish. And in case the market goes up, the share price increases, then we'll incur losses. Square off is a term used to indicate that you intend to close an existing position. If you are long on a stock, squaring off the position means to sell the stock. Please remember, when you are selling the stock to close an existing long position, you are not shorting the stock. When you are short on the stock, squaring off position means to buy the stock back. Remember, when you buy it back, you are just closing an existing position and you are not going long. Simply put, squaring off means we have completed the second step. Like in long, after buying, we have sold the stock at a high price. Similarly, in short positions, we have purchased the stock at a lower price after selling at a higher price. Lastly, a trading position is when you initiate to square off the position within the same day. It can be in both positions. We can take them as the total volume minus the delivered quantity is the intraday. Means, we bought them today and have sold them. What is remaining is deliverable, and whatever we have squared off out of total buying is intraday trading. So friends, this is all for now. I will be back with another section of your learning soon. Please subscribe to the channel to get regular updates. I ensure that your consistency with us will take you to perfection. Till then, stay healthy and happy. Don't forget to share the video and subscribe to the channel. Till then, all the best.